So let's assess that with Geoff Dennis. He joins in on the show right now. Geoff, hi, good evening to you and good morning from all the viewers here in India. Geoff, just wanted to assess whether or not there could be a contagion risk of the SVB fallout and what happens next, because Janet Yellen has been pretty categorical saying that the US government is not going to bail out SVB. So what happens then?
Well, I think the Fed's actions today make the risk of contagion much reduced. I think if we'd had no news over the weekend, the contagion risk would have been much higher. Now, clearly what they're doing is backstopping all the deposits, all the depositors as well, including those with large deposits. And therefore, I think the risk of there being a bank run elsewhere because people are concerned that, they could lose their money if the SVP depositors lose their money, that has been now substantially reduced. So I think the contagion risk is much reduced. Now, having said all of that, there are a lot of uncertainties about all of this, how this is going to be paid for, this backstopping of deposits. They're talking about a levy on the banking system. What does that actually mean? And of course, it does still point towards the question of, are there other banks that are in a similar situation to SVB who could get into trouble over the next few weeks? Now, if you allow me just to say this as well, SVB looks like a bit of a special case. It was a major lender, as we all know, to the technology sector. As those companies have shed labor and have really started to downsize significantly, the demand for credit has gone down. So the bank, SVB, has not been lending as much money to these companies. So they put a lot of money into the fixed income market, where there've been a lot of losses, of course, in recent months. And apparently they didn't do a lot of hedging. So it looks like a special case. And what the Fed has done today is very positive, I think, for the long-term outcome here. And also bear in mind, finally, in response to your question here, that the general capital situation of the major banks in the US is far better than it was in 2008, at the time of the global financial crisis.
Mr. Dennis, what are the chances that given what is happening to the US financial market, the Fed actually may be forced to consider a rate hike? The narrative changes. It may be a forced narrative, it may be a compulsive narrative, but the last thing you want to do is that increase interest rates again, which could have an impact on ALM mismatch further.
I think as you look at all the factors that would impact the next FOMC meeting and the policy decision that's taken there, this at the margin makes an aggressive rate hike at the next meeting less likely, because they're now seeing, the Fed and the world is seeing, the fragilities that could be being caused, and there may be other examples out there that we don't know about. And of course, Signature Bank also basically closed and was intervened over the weekend as well, an East Coast bank. All of these, the banking sector risks will make the Fed a little bit more cautious. So my view at the margin here is that it makes it much more likely you'll get a 25 basis point increase later this month, not a 50 basis point increase. And this is, I think, one reason why, plus the actual action the Fed has taken over the weekend to backstop these depositors, and therefore to try to eliminate or at least reduce the risk of contagion. This is why equities are snapping back. And so this situation, the Fed's response and the view that perhaps they will only move rates by 25 basis points, and maybe the peak in rates now is lower than it might otherwise have been, is good for equities. It's probably bad for bonds. You've got a gigantic rally in bonds on Friday. And it's also negative for the dollar. Dollar had a big rally. Flight to quality in bonds, flight to quality in the dollar on Friday. That's also unwinding. So this, there are more risks out there, but about other banks being in the same situation. But the Fed's rapid response to this, even though there's a little bit of stuff around the edges that we don't quite know, I do think is going to be something that will lead to a very positive reaction by the equity markets, everything else held constant.
Right. Geoff, great to have you on the show. The good news this morning is, and I'm going to skip Bitcoin here, but the marked recovery that you're seeing in the US futures, they're scaling up almost 400 points higher, pretty much undoing all of Friday's losses. And so is the SGX Nifty, by the way. It's indicating a flat start. There are other markets in Asia as well, like Japan, for instance, which is actually holding up in the green. So